The airline that promised $9 flights just filed for bankruptcy after a rescue deal imploded. Spirit Airlines didn't invent the budget carrier model, but they perfected the art of underselling everyone else. By the early 2010s, the airline had built a $4 billion business on a simple formula: strip away every amenity, charge for everything, and slash fares to levels competitors couldn't match. Those $9 flights weren't marketing gimmicks, they were real and they worked. Spirit became America's third-largest budget airline by capturing price-conscious travelers who'd never flown before, expanding aggressively across routes from Florida to Las Vegas. At their peak, Spirit was moving millions of passengers annually. But that growth came at a cost, one the company couldn't ultimately afford. Spirit's collapse didn't happen overnight. It started with a bet that turned toxic. Between 2013 and 2019, the airline spent billions ordering new aircraft and expanding to routes most competitors ignored. The reasoning seemed sound at the time: fly to smaller cities, undercut everyone on price, and watch the money roll in. But to fund this expansion, Spirit took on debt. Lots of it. Over $7 billion in total debt accumulated as the airline loaded up on Boeing 737 and Airbus A320, betting that revenue growth would always outpace the interest payments and fuel costs eating into margins. For a while, it worked. Spirit's stock soared. Then 2022 and 2023 hit differently. Fuel prices spiked unpredictably. Post-pandemic travel demand didn't bounce back as aggressively as projected. Worse, competitors like Southwest and American Airlines started aggressive pricing in Spirit's territory. Suddenly, Spirit's ultra-low-cost model couldn't absorb the pressure. Revenues plateaued while debt service remained a constant, crushing obligation. The airline was trapped. You can't shrink your way out of $7 billion in debt when your margins are already razor-thin. Every quarter, the math got worse. Spirit needed growth to survive, but growth was impossible. That's when the rescue deal became their only lifeline, and when it fell apart, bankruptcy became inevitable. Here's where the story takes a sharp turn. Spirit actually had a lifeline. In early 2024, a rescue deal emerged backed by Trump administration officials and private equity investors who saw potential in the budget carrier. The plan involved an injection of capital and operational restructuring that could have kept the airline flying. But there was a catch. Bondholders had to take a massive haircut on their investments. Spirit had issued over $7 billion in debt, and these bondholders held senior claims on the company's assets. The rescue deal offered them roughly 30 to 40 cents on the dollar of their original investments. That's a brutal loss. For context, when you've loaned a company $100 million, getting back $30 or $40 million feels like getting robbed. The bondholders did the math and realized they'd recover far more through a bankruptcy liquidation process than accepting this rescue deal. So they voted it down. Their rejection forced Spirit into Chapter 11, where the bankruptcy court would distribute remaining assets to creditors in order of seniority. The irony is stark. By rejecting a rescue that could have preserved some operations and ongoing value, bondholders triggered a complete shutdown that left them with even less. Spirit's lesson is that when debt piles up this high, even well-intentioned rescue deals can't bridge the gap between what creditors are owed and what the company can actually pay back. Here's what Spirit's collapse really teaches us about aggressive growth. The airline bet everything on a simple formula: keep fares impossibly low, pack planes to capacity, and expand aggressively. As long as volume kept climbing, the debt would pay itself off. But that strategy only works in a perfect world. The moment something breaks, whether it's fuel prices spiking, recession hitting, or competitors undercutting you, the entire structure collapses. Spirit couldn't pivot because every dollar was already committed to debt payments. When revenues plateaued after the pandemic, they had no cushion, no sustainable margins to fall back on. The airline had built a house of cards financed by $7 billion in borrowed money. One competitive squeeze, one market downturn, and it all came crashing down. The creditors who bankrolled this expansion. They're now facing the harsh reality that their investments are worth pennies on the dollar. That's the real cost of debt-fueled expansion without sustainable profitability. You can't outgrow bad economics forever. So what happens now? Spirit's collapse means the budget airline market is consolidating fast. Surviving carriers like Frontier and Allegiant will absorb Spirit's routes and passengers, but don't expect those $9 fares to stick around. With less competition and higher operational costs, baseline ticket prices are climbing across the industry. If you've been banking on ultra-cheap flights, that era is officially over.